the ultimate destination for smart investing. Welcome to Invest Ideas, where we turn your financial dreams into reality. Subscribe now and join us on the path to financial freedom. Hey there! In this article, we're going to talk about 7 dividend stocks that generate more than $500 per month. Dividends are becoming more popular as the market continues to shift towards value stocks and stable companies. Many of these stable companies pay dividends, and the passive income generated from owning these dividend-paying stocks can be very valuable for investors looking to increase their passive income streams. But first, let's take a moment to explain why companies pay dividends. When companies make a profit, they need to do something with that profit. They usually have a few different options. They could reinvest their money into the business, creating better products and hopefully gaining more market share. Or, they could pay some of that profit back to their shareholders in the form of a cash dividend payment. Just by owning a dividend-paying stock, you usually get paid a cash payment dividend every quarter. If you compound these dividends over time, the effects can be pretty amazing. Now, before we get into the list, let's talk about some of the pitfalls to look out for when it comes to dividends. This part is important, so don't skip it. Back in the day, some investors used to just look for a company with the highest dividend yields, like over 10%, and just invest in that. But you're going to want to be a little bit careful of that because that's what's known as a dividend trap. I think anything over a 5 or 6% dividend yield should be looked at a little bit closer because that kind of tells you that they're not reinvesting their money into the business. Perhaps they're paying too much out in dividends to their shareholders, or the company's stock price has fallen so much that the dividend now looks like a larger percentage of their entire stock price. I'm not saying all high yielders are bad stocks, that's not what I'm saying at all. But anytime you see a dividend yield over 5 or 6%, you should do some more research. Now, let's get into the list of the 7 dividend stocks that generate more than $500 per month. JP Morgan Chase, JPM. JP Morgan Chase, JPM, is one of the largest and most well-known financial companies in the world. It operates in a range of financial services, including consumer and community banking, commercial banking, asset management, and investment banking. One of the key reasons why JP Morgan Chase is an attractive dividend stock is its current dividend yield of 3.4% to 3.5%, which is higher than the benchmark S&P 500 yield of around 1.7%. While 3.5% is not a particularly high dividend yield, it is still a reasonable return for investors seeking income from their investment portfolios. Moreover, the company's dividend is backed by strong financials, with $1.7 trillion in liquid assets, of which over $700 billion is cash. This means that the company has a significant cushion to weather economic downturns and maintain its dividend payments even in difficult times. Another reason why JP Morgan Chase is an attractive dividend stock is its positioning in the financial sector. As interest rates rise, banks are able to profit from the difference between the interest rate that they charge customers and the interest rate that they pay on deposits. This is known as net interest income, and it is a key driver of profitability for banks like JP Morgan Chase. With the Federal Reserve expected to continue raising interest rates to combat inflation, JP Morgan Chase stands to benefit from an increase in net interest income, which could support dividend payments and further growth for the company. JP Morgan Chase is an attractive dividend stock due to its current dividend yield, strong financials, and positioning in the financial sector. With its stable business model and potential for continued growth, it is a solid choice for investors seeking income and long-term capital appreciation. AT&T, T. AT&T, T, is a telecommunications company that has been a reliable source of income for dividend investors for over a century. Currently, it pays out 52 cents per share each quarter, which translates to an impressive dividend yield of around 8.8%. The high yield is due in part to the company's declining stock price over the past few years, as investors have become concerned about AT&T's large debt load and declining revenue. Despite these concerns, AT&T has continued to generate significant cash flow, which allows them to continue paying their dividend. They also have a strong position in the market, with their wireless network covering over 99% of the US population. As 5G technology becomes more widely adopted, AT&T is well positioned to benefit from the increased demand for data and connectivity. This is because they have invested heavily in their 5G network, and they are working to expand it across the country. However, some analysts have raised concerns about the sustainability of AT&T's dividend, given the company's large debt load. They have taken on significant debt in recent years due to acquisitions, including the purchase of Time Warner, which was a major contributor to their debt load. This has led some investors to question whether the company can continue to generate enough cash flow to support their dividend payments. Despite these concerns, AT&T's management has indicated that they remain committed to paying their dividend, and they have taken steps to reduce their debt load. They have sold off non-core assets and are focusing on improving the performance of their core businesses, including their wireless and media divisions. AT&T is a well-established company with a strong market position and a history of paying reliable dividends. While there are some concerns about their debt load, the company is working to address these issues, and they remain committed to paying their dividend. As a result, AT&T can be a solid choice for income-focused investors who are willing to accept a slightly higher degree of risk in exchange for a higher yield. Altria Group, MO. Altria Group, MO, is a tobacco company that has been operating for over 180 years and is best known for producing Marlboro cigarettes. Despite the decline in cigarette smoking in recent years, Altria has continued to generate strong cash flows and maintain their dividend payments, making them an attractive choice for dividend investors. As of February 2023, Altria's dividend yield is around 7.6%, which is significantly higher than the average yield of the S&P 500 index. This means that for every share of Altria that an investor owns, they will receive a quarterly dividend payment of 90 cents. Altria has a long history of paying dividends, and they have increased their dividend payout for over 50 consecutive years. One of the reasons why Altria has been able to maintain its dividend payments is its strong position in the tobacco industry. Despite the negative health effects associated with smoking, cigarettes remain a highly profitable industry. Altria's Marlboro brand is one of the most popular cigarette brands in the world, and the company has also diversified its business by investing in other areas such as cannabis and e-cigarettes. In addition to their core tobacco business, Altria has made significant investments in the cannabis industry. In 2018, they invested $1.8 billion in Canadian cannabis company Cronos Group, and in 2019, they acquired a 45% stake in leading cannabinoid company, Juul Labs. These investments could provide additional growth opportunities for Altria in the future, as more countries legalize cannabis. However, it is worth noting that the tobacco industry is facing increasing regulatory and legal pressures, which could impact Altria's future performance. In addition, the declining popularity of smoking could also impact the company's revenue and profitability over the long term. Altria's strong cash flows and long history of dividend payments make it an attractive choice for dividend investors. However, it is important to consider the potential risks and challenges associated with investing in a tobacco company. Realty Income Corporation, O. Realty Income Corporation, O, is a real estate investment trust, REIT, that specializes in commercial properties. REITs are companies that own and operate income-producing real estate properties and are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. Realty Income has a dividend yield of around 4.5%, which is higher than the average dividend yield of the S&P 500. They pay out $0.2355 per share each month, which translates to an annualized dividend payout of around $2.83 per share. Realty Income is known for their consistent and reliable dividend payments, and they have increased their dividend for 52 consecutive years. This makes them a popular choice for income-oriented investors. One of the key advantages of investing in a REIT like Realty Income is that they provide exposure to the real estate market without the need to buy physical property. Realty Income's portfolio of properties includes a diverse range of tenants, which helps to mitigate risk and provide stable cash flows. They primarily focus on retail and commercial properties, with a particular emphasis on freestanding properties that are leased to tenants under long-term, triple net leases. Triple net leases are a type of lease in which the tenant is responsible for paying for property taxes, insurance, and maintenance expenses in addition to rent. This means that Realty Income is able to generate steady rental income while also minimizing their operating expenses. Another key advantage of investing in a REIT like Realty Income is that they are required to distribute at least 90% of their taxable income to shareholders in the form of dividends. This means that investors can benefit from regular income payments without having to sell their shares. Realty Income is a solid choice for income-oriented investors who are looking for reliable and consistent dividend payments. Their portfolio of diversified commercial properties and focus on long-term, triple net leases provide stability and steady cash flows, making them an attractive option for those looking for exposure to the real estate market. Coca-Cola, KO. To add more detail to the elaboration of Coca-Cola, KO, as a dividend stock, it is worth noting that the company has a long history of paying consistent dividends to its shareholders. In fact, Coca-Cola has paid a dividend every year since 1920, making it one of the most reliable dividend stocks in the market. In addition to its iconic soft drink, Coca-Cola's portfolio of products includes other popular brands such as Sprite, Fanta, and Dasani. They also have a strong presence in international markets, with over 200 countries selling their products. This diversification helps to mitigate risks from changing consumer preferences and economic conditions in any single market. Coca-Cola has also made efforts to adapt to changing consumer preferences and concerns about health and wellness. They have introduced low and no sugar versions of their popular drinks and expanded their offerings to include non-carbonated beverages such as tea and coffee. Additionally, they have made commitments to reduce their environmental impact and increase sustainability in their operations, which may be attractive to socially responsible investors. Coca-Cola's strong brand recognition, diversified product portfolio, and commitment to innovation and sustainability make it a solid choice for dividend investors. While the dividend yield may not be as high as some other stocks, Coca-Cola's long history of consistent dividend payments and potential for continued growth make it a reliable investment option. AbbVie, AbbVie. AbbVie, AbbVie, is a pharmaceutical company that has been consistently paying dividends since its spin-off from Abbott Laboratories in 2013. AbbVie's dividend yield of 4.6% is relatively high for a pharmaceutical company, which makes it an attractive option for income-seeking investors. They have a solid track record of increasing their dividend payouts, with a 10-year dividend growth rate of 18.4%. One of the key drivers of AbbVie's dividend is their blockbuster drug Humira, which is used to treat autoimmune diseases such as rheumatoid arthritis and psoriasis. Humira is one of the best-selling drugs in the world and generates a significant amount of revenue for AbbVie. However, the drug is facing patent expirations and biosimilar competition, which could impact AbbVie's revenue in the future. To mitigate this risk, AbbVie has been investing heavily in their pipeline of new drugs, particularly in the areas of immunology and oncology. They have a number of promising drugs in late-stage development, including Rinvoq for rheumatoid arthritis and Skyrizi for psoriasis. These new drugs could help to offset the decline in Humira sales and provide additional revenue growth for AbbVie in the future. AbbVie's strong dividend yield and commitment to increasing their dividend payouts make it an attractive option for income-seeking investors. However, it is important to keep an eye on the potential impact of biosimilar competition on their revenue and monitor the progress of their new drugs in development. Chevron, CVX. Chevron, CVX, is one of the largest oil and gas companies in the world, with operations in more than 180 countries. The company has a long history of paying dividends, and currently has a dividend yield of around 5%, making it an attractive option for income investors. Chevron's dividend payments are consistent and reliable, and they pay out $1.34 per share each quarter. Despite the challenges faced by the oil and gas industry, Chevron has a strong balance sheet and a diverse portfolio of assets that includes both upstream and downstream operations. This diversification helps to mitigate risk and provide stable cash flows. Chevron is also investing in new areas such as renewable energy, which could provide additional growth opportunities in the future. The company is committed to reducing its carbon footprint and has set ambitious goals to increase the use of renewable energy sources and reduce greenhouse gas emissions. However, like any company in the oil and gas industry, Chevron is subject to market fluctuations and the volatility of oil prices. As such, investors should carefully consider the risks associated with investing in the company, particularly in light of the growing concerns about climate change and the transition to a low-carbon economy. Chevron's strong balance sheet, diverse portfolio of assets, and commitment to renewable energy make it an attractive option for income investors seeking exposure to the oil and gas industry. However, investors should carefully consider the risks associated with the industry and make sure the stock aligns with their investment goals and risk tolerance. In conclusion, these 7 dividend stocks offer a range of opportunities for investors looking to generate passive income. However, it's important to do your own research and carefully consider the risks associated with each investment before making any decisions. Remember, dividend payments are not guaranteed and can be cut or suspended at any time, so it's important to invest in companies with strong fundamentals and a track record of consistent dividend payments. Thanks for tuning in to Invest Ideas, where we bring you the latest insights and strategies to help you make informed investment decisions. Don't forget to hit the subscribe button and stay ahead of the game. Until next time, happy investing.